Hello, everyone, and welcome to EY India's podcast series. Today, we are going to talk about Global Capability Centers or GCCs and the impact that Budget 2026 has given to the GCC sector. My name is Ritika Logani Gupta, and I am the GCC sector tax leader in EY India. In today's podcast, I'm also going to be joined by my colleagues Vijay Iyer, who's the national leader for transfer pricing, and Nikhil Suri, who's a partner in the indirect tax space focusing on the GCC sector. Global Capability Centers, or GCCs as we call them, are a backbone to the India economic and technology space. Today, as we speak, India is home to 1800 GCCs with employment of 2 million people plus. Every year, we are adding 100 GCCs within the India economic space. Historically, GCCs were always taken as cost centers and back office support centers. But over a period of time, the space within which GCCs are operating in India has really changed. They are doing technology advancement, advanced analytics, innovation, research and development, along with supporting their global parent companies. GCCs are also moving up the value chain as they've now found a seat in the global organization. A lot of global roles are moving to India. So there's lots happening within this sector. But one of the things that every time we speak to our GCC clients comes about is what is the tax certainty and the regulatory certainty that India is providing. And some of these issues have been long standing and always becomes a point of discussion when companies are planning to set up operations in India. Budget 2026 has, I think, taken care of a lot of these issues that have been plaguing the sector, ranging from safe harbour amendments to APA amendments to amendments in the GST law. And today, we are going to unpack all of these changes that Budget 2026 has provided for. Vijay, you are obviously on the transfer pricing side. Tell us what has really changed on the safe harbour pricing rules.
So it's a tremendous change that has come about. The whole genesis of this is that over the last, let's say, 20 years, the concept has always been that if you're going up the value chain, you earn more profits. And there was always a dispute as to whether you're doing high-end or low-end work. High-end was seen as a negative connotation and it meant higher margins. And taxpayers were trying to cut down on the amount of work they moved into India because it just meant higher profits and higher taxes in India. What has now been said is that it doesn't matter where you are on the value chain, we will give you a consistent price and a consistent margin and your tax is certain, which is a huge change. So the story now is that you bring in all your processes to India, bring in the high value add work, and we will give you the paraphernalia to work on this, and we'll not trouble you with taxes. You offer a safe harbor margin of 15.5%, and thereafter there'll be no questions asked. Of course, there is a threshold of 2,000 crores for the size of the GCC, but I think that takes care of over 80% of the GCCs in the country. So a large population is now being told that don't hold back your processes, bring them in, let's go up the value chain, let's create the ecosystem, and we will let you have tax certainty. Of course, there are still some checks and balances. You cannot run the entire process end to end from India. India still has to be a back office, as they call it. So there is someone who's controlling and supervising these decisions, someone who's managing the flow of the transactions, and the work is getting offloaded to India to perform a part of the overall puzzle and not the whole of it. So that is a check and balance there. But to that extent, once you're following that, which is most multinational processes, you will be eligible for the safe harbor, and then that really helps you to manage your tax function very well.
Great. So safe harbor really does away with the big controversy that has been plaguing this sector around what margins they should earn for offshoring work to India, right?
Yes, exactly.
Great. The other change or the other route that GCCs could take is on the advanced pricing arrangements. And I think there's been some change on the APA provisions as well. What are your thoughts on that, Vijay?
So a large population will fall out of the APA regime now because you have 15.5%. APAs were happening at 17.5%. So there is already a big concession. Good case for taxpayers to take up the safe harbor and not have to go for APAs. But there may be people who may choose to do a bilateral APA. They don't want any dispute in the other country. To that extent, there may be APAs, and some of the larger companies may have to do APAs. And the non-GCC sector also needs some support, and some of these IT companies, they also need some kind of APA support. So they put a timeline that for the ITS kind of businesses, there is a 2-year timeline within which the APA will get completed. It can be extended by a further period of 6 months. So in those 30 months, certainly you will get your APA done, which was taking up to 4-5 years at times. I will admit that some of the recent cases, the AP authorities have been extremely quick and they've wrapped up these cases within 12 months. But yes, a 24 months or 30-month timeline is a good time to finish these cases. And so our pending cases, as well as the ones that are coming in now, can get settled. So the inventory might go down, but the speed of closure is also there. So I think it's a win-win for the taxpayer.
Sure. Okay, moving on. I think the other issue that has been really bothering the GCC players in the country is on the GST. And how should the services be classified, whether it is export of services or intermediary? And I know from practical experience and with discussions with tax directors that millions of dollars are stuck either as refunds or, time and effort is also going on litigation. Nikhil, what's changed in budget 2026?
Thanks, Shrutika. You're absolutely right. The whole intermediary issue has been plaguing the entire service sector industry. I think it was one of the biggest issues that the service sector was facing till date, including the GCCs. And as you rightly pointed out, for the GCCs, the issue was really impacting their cash flow, translating into elongated litigation, etc., and therefore really impacting the working of the GCCs. And the messaging going out of India was fairly negative in that sense. To give you a quick background about the intermediary litigation, intermediary as a concept provides that if an assessee or a taxpayer is treated as an intermediary by the tax authorities, then their services, even if it's provided to a recipient outside of India, does not qualify as exports. The provision was typically meant for agents, brokers, etc., across different industry segments. Unfortunately, the whole concept was also extended to the GCC industry, and the GCCs, across India also faced this litigation, and they had to travel all the way to high courts to get a settlement of this issue. But across various jurisdictions in India, this issue continued to surface every now and then, and therefore bother the GCCs. Not only did it result in a impact on their output liability, but the bigger impact was on the refunds. As an exporter of services, GCCs are allowed to claim a refund of the input GST paid on their procurements. And this litigation was impacting in a big way their entire cash flow, which was locked in litigation for years and years. With the 56th GST Council meeting announcement in September 25, the intention was clearly articulated by the tax authorities that they want to get away with this intermediary concept and therefore, minimize the litigation for the GCC sector and across the service sector. This decision or the recommendation of the council has now translated itself into the Finance Bill 2026 and is awaiting ratification. Once the bill is ratified, I think it will be a big relief for the GCCs as along with the entire service sector as well.
So looks interesting for the GCC sector as we speak today. The other big bang change which has really happened is around cloud and digital infrastructure and data centers. We all know that GCCs today are heavily dependent on cloud infrastructure, on the digital infrastructure, and they also operate data centers in India. The budget has now given a tax holiday to foreign service providers who operate using India data centers, a tax holiday which extends up to 2047, and that's a big change that has happened. Vijay, your thoughts on that and how does that impact the GCC sector?
So it's add-on because it's a parallel business that most GCC would like to get into. So they'll create their own data centers, and then their data center, for having a critical mass, needs to have utility for customers outside of India as well. You will not be able to economically run the data center with only India data. You need global data to come in there. And this exemption now permits you to use the India data center for your global data. So I think it really is the next level of change that we needed. Uh, there were data centers who were using it for their global, but there was always a question mark on the taxability, which held back again investments in data centers. But now India can become a hub for data centers if it can be used partially for India, partly for global. So it will really help to use these data centers on a very large scale. So we're looking at multi-billion-dollar investments coming in as a result of this. And there was the other element of a data center is how much should India charge for the use of the data center? For that, there is a safe harbor again, saying that you earn a 15% margin on the data center cost, and that should be enough. And the rest of the profits earned by the foreign company will not be taxable in India. I have a point of view that the 15% is high and needs further recalibration because it's a highly capital intensive business, and therefore the 15% is on the higher side for typically a contract services, contract manufacturing, capital intensive business. So I think the number should have been single digits. So we'll need to see how that evolves. But at least we now have a cap. We have a ceiling that in the minds of some people in the department, they believe that 15 is the highest that you can look at. Our guess is that we should be looking at something much lower. So that's something that will still evolve. It's not like the 15.5 safe harbor for the other services. This is slightly on the higher side. So we may need to go back and see how the government redoes these numbers.
Sure. And Nikhil, any interplay with GST for data centers?
Yeah, I think data centers are only going to increase their uses, right? I mean, with AI sort of around the corner, I think the extent of or the requirement for data centers will only increase. With the government sort of encouraging more and more data centers in India and through these tax and regulatory measures, I think it will be a big boost for the economy. And even from a GST perspective, I think it will generate greater revenues for the government in India. So I think it's just a big step up or a boost for the economy in general.
Sure. So let's kind of now put this all in a practical perspective. What are we going to advise clients who are planning to set up GCCs in India or looking at expanding existing GCCs in India? I'll go first and tell you what are we seeing in the GCC ecosystem. So I think the first decision point should be that this GCC that is being set up, are you looking at scalability or capability or both? The second important aspect is tax certainty and regulatory certainty. That's important, and that is what GCCs who are planning to set up operations need to look at. The third important part is there should be a complete alignment between tax, operations and contracts. Because if these three are not together, there are definitely going to be issues in doing business in India. Vijay, your thoughts on what should GCCs be looking at from a transfer pricing perspective?
So they need to have their SOPs well documented. So certainly it's the best time to come in and do business, there's no doubt. But as I mentioned, there are some checks and balances. So you should keep your documentation for any kind of examination. You will have to prove that what is happening in India is a part of an overall larger super system, and India part is kind of a subsystem to that. And what is the flow of information coming in, what is the process being run in India, and what is going out. So that SOP is good to have. You have to have the right control and supervision in the country. You have to have the right contracts, as you rightly said. So if you do the homework properly, I think you will be protected from any adverse tax consequences. You can get covered under the safe harbor, and things should help you to grow substantially over a period of time.
Great. Nikhil, I want you to focus on one of the important aspects that GCCs are currently looking at. They are also looking at scalability here, and a number of states today are offering incentives, both fiscal and regulatory, under the state GCC policies. Tell us something what's happening in that space.
Yeah, absolutely. Ritika, so with 1800 GCCs already existing in India, and the expectation that it will translate into about 3000 GCCs in the next few years, I think the one of the biggest things that GCCs need to sort of factor in and examine before they really decide to set up is the place that they want to set up. Of course, availability of human manpower is a key factor in terms of the GCC capabilities that are required. But besides that, the tax incentives that are being offered are tremendous, and they vary from one state to another. And therefore, it becomes a very important sort of an aspect that GCCs need to examine, that which would be the appropriate state for them to sort of set up, so that they're able to maximize the tax incentives while obviously balancing it out with this requirement or the availability of the skilled manpower. So, for example, in the last few months, states, some of these states which have been offering is widespread, whether it's Tamil Nadu, Karnataka, Maharashtra, etc. But even in recent times, some of the northern states like Uttar Pradesh has also come up with a policy. We're expecting Haryana to sort of come out with a policy. And there are many more states which have already introduced such policies. So it's a very important decision before the GCCs decide to set up in India, to have a detailed analysis of which state that they should set up, because that's a long-term decision that they make once they set up a center in India.
I think one more important change that the budget has given for GCCs and focusing in the BFSI sector, which is the banking, financial services and insurance sector. GIFT City has been catching the attention of most companies or MNCs wanting to set up. There was a tax holiday that was given for companies setting up GCCs in India in the GIFT City for 10 out of 15 years. The government, with an impetus to promote GIFT City, has now changed this tax incentive from 20 out of 25 years. So there's been a clear change of an extended tax holidays for GCCs wanting to set up operations in the GIFT City. So I think that's another important change that's happened. So to wrap up, Budget 2026 provides a clear signal to the world. India is definitely the place for GCCs to be. There are tax incentives, there is fiscal clarity, there is tax clarity, safe harbor provisions, advanced pricing arrangements, clarity on the GST reforms. With that, we conclude our today's episode on the EY podcast. Keep watching us for more information to come in. Thank you.